Hi, everybody. It's David Fleming here from the Toronto Realty blog, and welcome to your Monday Mortgage Minute. I just made that up right now. Welcome to your video. This is a video that Tony Delasuca and I, my mortgage broker, have put together to answer your questions. So thank you so much for everybody that put a question together on Friday's blog. Let me introduce Tony. How are you doing, and how do you like using Zoom for everything?
Dave, I'm doing well. Seems to be the go-to kind of meeting spot right now. So it's about 2 or 3 a week, and I'm getting used to it. It's not bad. I feel important these days.
Did you have a Zoom call with your friends on Saturday night like I did?
It's a bit of Zoom and it's a bit of house parties. So I toggle back and forth depending on the friends. So we got Zoom for some, and we got house party for the other, and then you've got your standard FaceTime for family. So it's
Yeah.
platforms doing the same thing. Gotta love it.
Awesome. And of course, the other part about Zooming and working from home is my daughter's trying to get into the office right now, which I think everyone's going through. And then you've got people looking at each other's backgrounds, like you're literally standing in front of a wall of nothing. And I have all the crap that my dad has bought me. This is all stuff from my dad he buys in his travels, and I have to display it somewhere. So here it is in the background of all of my videos. So I don't know that.
The books are to the right of you, I imagine.
What's that?
The books are to the right of you, I imagine.
Yeah. Oh, yeah, yeah. So you saw me on CTV. So yeah, that was when I was on CTV. They're like, maybe you can go somewhere a little more interesting. So yeah, do you want to see books and I can pretend like I'm smart, like a professor? So this is the funny part about Zoom is that whenever you do it with people at work, you spend the first few minutes scoping out everyone's surroundings, and then you kind of get down to
I keep
business.
it neutral, white background, and maybe I can play with the background and put some like towers or something back there, or buildings, or I don't know. But
Yeah, yeah,
you
yeah.
got me way right now.
No, you look good. You look good. Okay, I look great, except I did this to my hair. I don't know if I wanted to get out ahead of it so that no one messages me and says, "What the hell did you do?" So I had the clip for the zero on there, thinking it was the two, and I went right down the gut, and then I had no choice but to even it out. What do you think?
If I had to make a recommendations, I would try to blend in the sides a little bit. Maybe make your ears look a little smaller.
I tried that and then this happened. Anyways, okay, enough about hair and Zoom and backgrounds. But this is actually a testament to how most people are working right now, which is spending the first few minutes of every work hour just wasting time. Okay, so Tony, we have a bunch of questions from the readers, and I figured we would get right into them.
Great, bring them on.
This is from blog reader Natrx, a regular reader and commenter. What are the chances the lender reduces the amount from their pre-approval during closing? I've heard this before. Brokers were seeing an uptick in deals not being able to close. So Tony, two-part question there. First, what are the chances the lender reduces the amount from the pre-approval? And then Natrx is saying that he's heard that brokers were seeing an uptick in deals not being able to close.
Yeah, obviously, like the concern for the banks now is twofold. One is employment for people. Are they currently actively working? How has COVID impacted their ability to work? So are they working remotely? Are they having a reduction in hours at work? And so the landscape is pretty much changed across the board for everybody. The short answer is banks can pull deals at any given time if there have been material changes to that mortgage approval from the get-go. So for example, someone is buying a house, they're closing July the 1st, and ultimately what happens is someone may have lost their job or a reduction in hours. The bank could go back and look at that and try to figure out what the best solution is for that borrower in terms of will they be able to make those mortgage payments down the road. So the answer on that first question is, can banks pull back the pre-approval? The answer is yes. If there's been material changes to that deal, they will sometimes either reduce the loan amount or alternatively try to figure out a solution in terms of how are they going to recover those savings in terms of the difference in equity that they've been approved for. So do they have savings set aside? Is there a co-signer that we can add? Can we extend the closing? So these are all measures that we try to put in place to make sure that the borrowers can ultimately qualify for the mortgage that they had previously.
Gotcha. Okay. And so Natrx says he's heard even before this, brokers were seeing an uptick in deals not being able to close. What's your experience with that?
Yeah, my experience so far is I haven't personally experienced anybody not being able to close. What we have found is some lenders will reduce the loan amount on some pre-approval. So let me give you an example.
Sure.
Someone is currently employed full-time and they have a part-time job at a restaurant. They're obviously not working at the restaurant, but historically they've been doing that for 2 years, 3 years. The banks are aware of the fact that at some point in time they will go back to work. So lenders will typically use that income if it's they will use that income if it was approved for previously, before the pre-approval was done.
Okay.
If the pre-approval comes in as of today and they're saying to us, listen, I currently work at Jack Astor's or Milestones or whatever the case may be, the lenders will not look at that currently right now. They're saying you're currently not working.
Right.
So the question becomes, when were you employed with some of this part-time work, to make sense of the fact that will you have that income moving forward when you're ultimately buying a place or have purchased a place?
Okay, gotcha. Okay, so that kind of ties into the next question, which I don't think is necessarily redundant. Mike says, my question is not necessarily COVID related. Can the banks pull a firm mortgage commitment at any time? If the borrower has signed all the paperwork, let's say 1 week before closing, can the bank get out of the deal? So in this case, Mike is talking about essentially a deal between a borrower and
Sure.
the lender. So can a bank pull a commitment at any time?
Yeah, I mean, again, just to go back to my previous comment, the answer is yes. In most cases, if your deal has been approved and there's a week before closing, it's very unlikely that an institution will go back and pull that file 1 week before closing. There would be
Okay.
no reason to do that from the bank's perspective, given the fact that you've signed and generally met those conditions, the mortgage instructions have been sent to the lawyer. Now, for deals that are closing perhaps in June or July, a lender may go back and look at some of their approvals and look at their files and say, is this person still actively working? What's the current situation of these individuals that we
Mhm.
pre-approved or approved 2 months ago, and now their deals are closing in, say, 6 weeks or 8 weeks? You know, the banks are lending you their money. Don't forget
Mhm.
that. So the banks have the right to go back and take a look at each file and assess it case by case to say whether or not they want to continue lending on that file, particularly if there have been material changes to that file. Someone lost their job, someone is
Mhm.
currently maybe on EI or now on mat leave, whatever the case may be. So we've got to be careful in terms of just making sure that we're not putting clients in mortgages that they can't afford to make payments on. And I think this is something that I touched upon in my blog is
Mhm.
we're doing a disservice to clients if there have been things that have changed in their income or their employment, whatever the case is, and then we're asking them to make those mortgage payments once the deal closes.
Right.
So my suggestion is always to make sure that we're telling the upfront story to the banks if there are any changes to mortgage applications or employment or reduction in income, whatever the case may be.
So, okay, let me ask a follow-up question here before I get back to the readers. Let's say that somebody had a pre-approval and they're going with a certain lender and their closing's a ways off. If one of those people lost their job, does it make sense for them to get out ahead of it, be honest, whatever words you want to use, go to the lender and say, hey, here's what happened. What do we do now?
Yeah, I think the answer is yes. I mean, obviously, in that case, there's been material changes to one of the applicants. So
Okay.
we would notify the lender and say this individual is currently not working. And then what we would normally do is just wait either until we can extend the pre-approval once they're back working again, or ultimately try to figure out a solution by either potentially adding a co-signer or a guarantor to the mortgage to
Hmm.
help them qualify for that mortgage. And don't forget, you know, people who are pre-approved are still in the process of looking for a property. And, you know, in today's landscape, you probably know this a little bit better than I do, but it seems like the majority of properties are on hold. Not very many people are looking at things. You know,
Yeah.
some of it is being done remotely, but more often than not, everything is sort of on pause right now.
Hmm.
And similarly for pre-approvals, we want to encourage our clients that if you were pre-approved 3 months ago, that might not be the case today because there have been material changes to, again, your employment or your salary or whatever the case may be.
Right. So, okay, one more follow-up question before I get back to the readers. So, somebody gets a pre-approval from you, let's say a broker from a bank, and
Sure.
they're all excited because they've got a rate hold. So, let's say that in this climate right now, and you're right, not a lot of people are looking right now. I mean, I got an email last night from two people that said, once this is all over, we want to hit the ground running. I guess maybe they were thinking early 2020. Maybe it's time. Maybe there's a pregnancy. Maybe there's a job transfer. Whatever the reason. So I'm not extremely active right now, but people are getting ready for this to blow over and to get back into the market. So let's say that somebody has a pre-approval and for whatever reason they find the dream property. Maybe it's listed for sale. Maybe there's as I said in my blog video last week, somebody's put motivated seller or price to sell, and they do want to go out there. Those pre-approvals um, aren't necessarily still in place. So it's, the protection that you might have had before, you may not have any longer.
Sure. I mean, the answer is, yeah, you're right. but the reality is that would have been the case regardless. So for example,
Right.
pre-COVID, someone who was pre-approved for a mortgage, call it a year ago,
Yeah.
and they lost their job, the same situation would arise. So, COVID hasn't really changed the policies and procedures from what they were 6 months ago or a year ago. Those are still in place. You have a job, you lose a job, you were pre-approved. The reality is you're no longer working. So those policies really haven't really changed that much. What COVID has changed is maybe someone may have lost their job as a result of COVID, or maybe someone's hours may have been reduced because of COVID. Those are the scenarios that we're trying to solve and figure out, from someone that was earning a salary of $60,000 and now their employer said, listen, we have to cut your hours back. You're only earning 40.
Right.
But when we submitted those deals to the lender, you were earning 60.
Right.
So those are the situations that are a bit unique and they're a bit tricky to kind of navigate at this time. Is what are some of those material changes in either employment or income, and how do we resolve them, not only for the borrowers, but also the institution, so that they know when they ultimately go back to work, they're going to be earning that income again.
Okay. All right. Good stuff. So let me get back to the questions here. So Condodweller, another blog regular, Condodweller says, I'm curious if Tony has any data on home equity line of credits, whether banks are reviewing them, reducing them due to income loss or new lending criteria, or even changing interest-only HELOCs to principal plus interest payments. And if so, how are they handling these, as presumably the change has a good chance of triggering the necessity of refinance, or in the least payment deferrals, as it would make the new payment unaffordable. So there's sorry, I was having trouble reading this. There's five questions in here all at once.
I think I get the gist of the question.
Did you get all that? Okay, good.
Obviously, secured line of credits add a bit of protection to individuals who are currently facing cash flow situations right now.
Right.
Historically, HELOCs haven't really changed that much either. I mean, you're making interest-only payments on the amount that you're borrowing. You have the ability to convert those payments into a fixed rate. So if someone wants to pull up, for example, they've got a HELOC of, call it $200,000, they want to take out $50,000 for whatever personal reasons, renovations, invest. They have the option to make interest-only payments on that money that they borrow, the $50,000.
Right.
They have the option to convert that into a fixed portion as well.
Okay.
We really haven't seen any changes on HELOCs from the major banks. They haven't really come up with any specific policies to say, we're going to take them out, or we're going to pull them back, or we're going to convert the interest-only payments to fixed principal and interest. Everything has sort of remained the same for home equity line of credits.
Okay.
And the only thing obviously that changes is the fluctuation of the prime lending rate. So depending on what your current interest rate, that will change what your payments would look like down the road if prime changes. So nothing has really changed for the home equity line of credits. And let me add, it wouldn't make, historically, the banks won't just arbitrarily stop providing home equity line of credits, nor would they take it back from someone. If you're making the payments on home equity line of credits, if you're haven't defaulted, the bank wouldn't just, again, arbitrarily come in and discontinue your line of credit for any reason.
Okay.
It would have to be some kind of either default or some kind of misuse of the line of credit, something that would trigger the bank to go in and look at it and say, listen, you've defaulted on 3 of these interest-only payments. We're going to currently freeze that account. But to date, nothing has really changed on the home equity line of credits either. There's still good utility products with the flexibility to, pull money out, take it back, and pay it back whenever you want, and then ultimately have just cash on hand that you may not have had 6 months ago from, maybe a reduction in work or, some of these situations that have arisen from COVID.
Okay. So what about, I had a client ask me this a week ago, so this is interesting timing. What about somebody that is afraid they can't make their mortgage payments, so they take out a home equity line of credit to pay their mortgage payments? I mean, that's washing one hand with the other.
Yeah. I mean, if you already have a home equity line of credit in place, then that's probably a solution for you. If someone is currently not working, you've either got to defer those payments or ultimately make those payments.
Right.
So my recommendation is, and this is something we touched upon the blog, is you have to find a way to either defer those payments or make those payments. If you have a home equity line of credit, then I would encourage people to use those funds to put down on the mortgage as mortgage payments. You've got to get the money from somewhere. And as we've been reading, these deferral payments have quite a little bit of implications that's tied to them on the fine print. Is you're making the deferral programs are simply deferred payments. They're not forgiveness payments. So keep in mind that you're deferring the interest. That interest is being added back to the principal amount of the mortgage, and then you're making those payments based on the new increased amount. So, if you had a mortgage of $500,000 and you deferred 6 months of interest only payments at $1,000, that's $6,000. Your new mortgage balance now is 506, and you're making payments of 506. So keep in mind that if you have the ability to make your mortgage payments and you've got to tap into savings or a home equity line of credit, most people are probably opting for that option. Okay. But ultimately, the line of credit is a bit of a security blanket that people should tap into if they have no other resources.
Okay. All right. Let's go to the next one here. So Deb says this might be a little novice for some people in here. Deb's clearly thinks she's going up against the regular readers and commenters. But can you explain the math in when it makes sense to refinance?
Yeah, so simply put, anytime someone is looking to refinance, we look at basically two criteria. One is the current interest rate of the borrower, along with the penalty that it's costing them to break it, and then we compare that to the new mortgage rate that they would be receiving versus the savings applied to that. So simply put, if you're breaking a mortgage whereby the interest savings offsets the penalty that it's costing you to break it, then you would refinance and borrow that money. Conversely, the opposite. If it's costing you money to break your mortgage and you're not saving anything, then we don't do it. So there are times and reasons where a borrower may say to us, look, the threshold is break even, or I may be losing a little bit, but I need 50,000 or 40,000 to tap into. In some cases we will do those refinances, but if it's costing someone, call it $15,000 to break their mortgage, and they're only saving 11,000, then you're obviously not going to continue to refinance that mortgage because it's costing you, the $4,000 to inherit that debt load.
And that's also over the course of the loan too. So it's not like you see it right away.
Correct. So we look at the remaining term of the loan. So again, it's the remaining term of the loan, the existing penalty, the current interest rate. There's 3 or 4 contributing factors that we look at. But overall, we want to make sure that the interest that it's costing you to break it doesn't exceed the savings that you would benefit from receiving that refinance.
Okay. So the next question is Chris. Okay, so Chris, I don't know how often you read the blog, but Chris is one of the 3. Well, right now he's probably the most active commenter, but right. one of in the last couple of years, probably one of the 3 most frequent commenters. So Chris has said, Tony, do you want to wade into our guessing game?
Let's do it. I've read a bit about this. So.
Oh, have you? Okay, so here's what happened. So Derek said we should put together a game. What metric will we use? I was the one that said, okay, let's use the average sales price because that's the be-all and end-all. So we put together this game. The February average home price was about $910,000, and it dropped to like $902 in March, which is very, very surprising. I thought it'd be less. So I think we can all agree, or maybe not, but the idea is that in April it's not going to be 910 again. When will it go back above 910? So I said in the fall, and then people started coming out and saying 2022 and all this, and I was like, guys, this is crazy. And then someone named Potato, who used to be a regular reader of the blog years ago, came out and said it won't go above 910,000 until the 2030s, as if that could be 2035. Now, call me a bull, call me a cheerleader, but that is crazy to me. Even with inflation alone, which I think we're going to have super inflation based on the government having to print money and pay all this back. Even with inflation alone, can you there's no way 15 years from now average house price isn't higher.
Yeah, I mean, look, I think 15 years is a bit ambitious. If I had to personally guess, I have full confidence in the Toronto market. It's been pretty resilient for the last, excuse me, 4 years, 3.5 years. We've seen a bit of the downturn. I think a few years ago, back in I think it was 2017, and now we're kind of stabilized a little bit in terms of price values just being under $1 million. If I had to guess, I think really the end game to this COVID-19 is a vaccine. Once we hear of either an anti-vaccine or some kind of antiviral or whatever the case may be, once we have that, which I think is about 12 months away, I think we're going to start seeing the Toronto market kind of go back to where it was. If I had to put a personal guess on this, I personally would say in 8 to 12 months, I think we're going to see values back to where they were, 950, 930, 920. But I would say my timeline is 8 to 12 months.
8 to 12. Okay, so let's say 12.
I think my personal thought is the psychology of the consumer has somewhat shifted now. we still have to restore the confidence of people being in large gatherings and wanting to go out and feeling like nothing has happened. And I think that part will take a little bit of time. It's unlikely people are going to go to concerts or sporting events anytime soon. So I think we have psychologically a long way to go before we feel comfortable being in big settings and being in social gatherings.
Yeah.
And I think the real estate market is a byproduct of that. Is ultimately people are going to want to see the houses, walk in, come out. So my guess is 8 to 12 months if I had to put a timestamp on it.
Okay, so Chris is collecting all the data on this. He'll repost. So you want to say April of 2021?
Yeah, I'll go. I'll be a bit more conservative. Actually, I'll be a bit more ambitious. I'll say a little bit earlier than that. I will say January or February of next year.
There it is. Okay, Chris, add that to the list. All right, let's do the last question here, Tony. So this is going to touch on a lot of what we've already done. So if this is from blog reader Ed, another common commenter, if someone's on the edge of getting approved for a mortgage before this crisis, how much harder is it for them to get approved today and why? What has changed in the approval criteria? Which of any of the big banks has made it more difficult? So I think we've touched on most of this so far, but is there anything in there that sticks out as maybe something that we need to clarify?
Yeah, I mean, is it any harder? I wouldn't use the word harder. I would think it's just being a lot more cautious of how these lenders are approving these deals. They're obviously becoming a lot more conservative in terms of refinancing for individuals, in terms of someone who's buying, they're just making sure that they're actively working and they're still earning an income. That really hasn't changed. I wouldn't say it's harder. It's just a lot more fact checking these days in terms of, are you currently working? Have your hours been reduced?
Right.
Is your down payment still in place? So all those things really haven't changed, but the banks are just asking more questions to ensure that, if you do have a job now, is it going to be impacted in 2 months, 3 months? Are you going to still have that job, in the upcoming weeks? So banks are just asking more questions, rightfully so.
Right.
And, brokers are probably doing a good job making sure that clients still meet the criteria to purchase or refinance, to assume the either additional debt on a refinance, or if you're buying, that you can afford to make those payments.
And so any difference with any of the banks that you've seen?
No, they're pretty much the same across the board.
Right.
All the major banks are sort of following the same guidelines. And just to be clear, there's really no policy that's come out that says, here is what we're doing for someone that's lost their job, or here's someone that we're doing for someone's income that's been reduced. These are one-off cases where we're trying to treat them individually, and so are the banks. And we're making sure that, we can address these issues with the borrower, with the banks, to make sure that obviously they can afford to make these payments. They're in line to till still close on their closing date, or refinance. They can inherit the additional debt. But we're just treating them on a case-by-case basis.
Okay.
But the banks have done a great job, I would say, in asking more questions, going back to the broker, and the broker going back to the borrower to say, hey, this is we want to make sure that you can afford to make these additional payments.
Okay. All right. Well, that is it for the questions. That's not bad. We're at about a half hour here. That's the average video length. Okay. Awesome. So listen, I will put this to the viewers on Monday. We'll see if there's any follow-up questions. If there are, I might reach out to you again, and maybe I could just answer that for them in the comments section.
Yeah, and what we could do is, if you see something where we want to go back to another question or elaborate on something, we can definitely do that. I mean, a lot of the stuff, some of the incentives from the government, I don't know how much that's impacting any of your borrowers, but to look at something like that, and then ultimately, if there's a specific question in there that someone wants elaborated, then we can certainly go back and if there's a prime example, or there's a specific scenario that impacts someone directly, we can go try to address that personally as well.
Awesome. Okay. All right, everybody. Thanks for watching again. Happy Monday. That is it for us. See you next time. Bye-bye.
See you.